So generally, which stocks to invest in, what type of stocks in a recessionary environment? Well, this would be your traditional playbook here. You're looking at generally, to start, healthcare related businesses is one area that essentially investors and advisors will tell you. It makes sense, be it pharma or medical devices. People need access to these life-saving products no matter what's happening in the economy. I'll give you an example of some. These are large U.S. companies: Johnson & Johnson, CVS Health, Pfizer, and United Group. The next group that is traditionally looked at are consumer staples. People need to eat even when the economy hits a rough patch. However, consumers tend to shift their eating habits from dining at restaurants to preparing more food at home. Grocery stores and packaged food makers tend to be somewhat recession resistant. Likewise, other consumer staples such as household and personal products tend to experience stable demand in recessions. These type of companies, again, I'm going with some of the larger U.S. companies here: Kroger, PepsiCo, Procter & Gamble, General Mills. Also, you can look at utility-like businesses. Even when businesses close or people lose their jobs during recessions, demand for electricity, wastewater, waste collection, natural gas, they remain relatively stable. Utilities and utility-like companies generate reasonably consistent earnings throughout recessions historically. Some examples of a utility or utility-like companies would be American Waterworks, Brookfield Infrastructure, which we know well, NextEra Energy. Finally, we'll look at kind of low-cost retailers. Consumers spend more carefully during recessions. Many people begin buying less expensive items. They also typically reduce discretionary spending. Instead, they usually spend more money at dollar stores, discount retailers, and buy basic foods and other basic requirements. Examples of these would include well-known names such as Walmart, Dollar General, and or Costco. And Costco has that beautiful subscription model as well. Now, I would add companies that offer more semi-essential services, such as auto repair. And a good example of this would be the Boyd Group. It's an auto repair consolidator that we have recommended for the past 15 years. They actually benefit sometimes in a downturn. So those are the type of companies, again, traditionally, that you can look at. Now, in my opinion, these are kind of goalposts, but they oversimplify the equation. For example, not every healthcare related business is the same. You can even have two healthcare related businesses that grow by acquisition, for example. They service the same niche in healthcare, but the capital structure or balance sheet on each of them do matter. During a recession, capital becomes more difficult to access, even for a great business. If a company has, I'm going to use company A and company B here. If company A has no debt and a strong net balance sheet, cash-rich balance sheet, versus company B with a heavy debt load, limited cash, and high debt service payments, there are opportunities and risks even in a recession between the two can differ greatly. Company A with a strong balance sheet can continue to execute on a growth by acquisition strategy, for example, from its internally generated cash and existing balance sheet. Company B will continue to have to service its debt and will find capital more difficult to access via either debt or equity, and it'll be more difficult to execute on a growth by acquisition strategy. Now, the bonus here in a recession is that company A is likely acquiring businesses now at depressed valuations. This is the best time to make those acquisitions, essentially. So company B, the debt-heavy business, misses out on, to a degree, on the best time to execute its own growth by acquisition strategy. Now, the question that we got, it went on to ask us to give an example of a kind of non-traditional example of a stock that could perform well during a recession. And I'll give you an example of that here. It's Enghouse Limited, symbol ENGH, on the TSX, trades around $32.70 now, $1.5 billion market cap, 2.77% dividend. Enghouse is a vertical enterprise software solutions company. It focuses on contact centers, video communications, healthcare, telecommunications networks, and public safety, and the transit market. The company's two-pronged strategy of growth focuses on internal growth from internal organic growth, which again, I'd like to see more organic growth in this business, but they are focused on that. There's acquisitions as well, which really drive the growth, which to date over its history have been funded through operating cash flow. Now, Enghouse has no outstanding debt and is organized in two business segments. That would be the interactive management and the asset management group. Now here we have, you can see the balance sheet here, huge net cash position, 250 million essentially in cash and no debt. The company also produces in the range of about 80 to 100 million annually in cash flow to fund acquisitions. Its universe of potential acquisitions in a recession comes on sale when capital is tougher to access. And those are the reasons why this is kind of a non-traditional way to play into a recession, buy a business that will benefit and come out on the other side looking stronger. And it's not a surprise to me that we look over the past month, the share price has been going up, whereas you look at the TSX Composite Index, on average, been going down. And if you look at the venture, down almost 9% over the past month. People are looking for safety. You can have safety in a good balance sheet in a business that is relatively recession resistant as well, but that's a non-traditional way of looking at it. And that'll finish it off.
Yeah, good summary. One piece of like learning that Ryan and Aaron taught myself is, in one of the chat sessions, we had a question come in from a client and was asking, generally what stocks are good to invest in a rising interest rate environment. And I was taught by a professor in school that generally utilities are where to place your cash. But, Ryan, we're always on the phone during our chat sessions. And I said that this is how I'm going to respond to it. And Ryan was like, wait, whoa, what do you mean? Like, it all depends. And exactly the points that you just went over, comparing company A to company B, just because interest rates are going up doesn't mean that every utility is a great investment, or general,
And utilities pay dividends. Often you're in it for dividends, particularly in the near term when it starts. They're competing for, exactly. In terms of your return that you can get on a risk-free investment, right? Mm-hmm. And they don't have to be, because they can be dividend growers over time, but particularly in the short term. And then many of them are debt laden, so their cost of capital is going up. Exactly. If they haven't. There's smart utilities that are using long duration that don't have the fluctuations, or they're hedging. But we shouldn't be surprised, but there's some that aren't doing it properly. There's tons of businesses that don't do their business properly. And that's why you have to look into a business. You can't just, I'm buying a utility at this time. It's utility A and utility B can be completely different when you look at them from a financial perspective.
That also assumes that you have the ability to time when the market is going to change as well.
Of course, right? There's overlay that on top of all of this, right? And you don't.
People will ask us, like, well, what do you think the odds are of a recession? And, saying that there's going to be a recession doesn't really give you much information. It doesn't tell you how long the recession is going to be, how deep the recession is going to be. So if you load up with utility stocks, you have a higher than normal allocation of just utilities because you expect a very stiff recession and you're wrong.
And then it doesn't happen.
Then that's not going to work out for you. So rather than trying to predict where the market's going to go, the better strategy is to build a portfolio that has a mix of different companies that are solid, profitable businesses. And a few of those may be utility style businesses. I mean, we found several in our income research that they have the defensive characteristics of utility, but then they also are able to grow their dividends, grow their earnings per share. So, they have a place in the portfolio, as do, top tech companies, top industrial companies, and other types of businesses as well. But by building a portfolio that is positioned to benefit or withstand any market or a variety of different economic scenarios, that's where you're setting yourself up for success. And you're not relying on your own ability to time the market and predict the future, which you're not going to be able to do time and time again consistently.
And there are people that will switch to those type of stocks that I just went over, and right now, and if you don't hit a recession, they may be completely wrong.
And then how do you know when to get out of those when the recession ends? right? And when money starts going back,
even if you're doing it through an ETF, how do you know when to time it? You're likely going to be, it's going to be a futile effort of chasing around where you think the economy is going to go. Rather than focusing on the companies, find the good business that has good cash flow. They tend to do better regardless of market conditions overall. That is a better strategy than trying to find out where you think the market is going to go next week, next year, or 3-4 years from now. All right, I think that ends that segment.